Good morning, ladies and gentlemen. My name is Tim Ralph. I'm a managing partner here at Biltmore Capital. I'm delighted that you have the time this morning to join me on this busy Tuesday. Today we're going to talk a little bit about allocating into international equities. Recently, markets have come under a lot of pressure. Recently, we've come under a lot of pressure, and what we're trying to talk about today is, even in light of this pressure, we do continue to drive our allocation really in a value tilt. Right now, we're seeing markets have pulled back from their highs. The valuations have as well. And so as we talk about the international space, we want to be cognizant of not only the developed world, but also the emerging world. So today I'm going to bring forward our Chief Investment Officer, Dr. Donald Chambers. Don's a former professor at Lafayette College. In fact, he's taught several students and interns here at Biltmore Capital, as well as our Chief Executive Officer, Tyler Vernon. Don's a very savvy investor, not only in the collegiate world, but also in practice. Years ago, Don worked in the private sector for a hedge fund that deals with a lot of closed-end mutual funds. Later on, he moved into teaching and ended up writing a lot of books, not only for his designation, the CAIA, the Chartered Alternative Investment Analyst, but now the CFA. It's a very prized designation, the Chartered Financial Analyst. So I want to bring forward Don. He's going to give us just, again, a presentation here in how we talk about international equities and think about international equities in our portfolio. After Don's done speaking, we're going to go through a little bit of Q&A. If there's some questions that you may have, please feel free to write it in on the question box over to the right-hand side of your screen, and we'll try to do our best to address your topics here today. So without further ado, I'd like to address our CIO of Biltmore Capital, again, Dr. Donald Chambers.
Thank you, Tim. This is fun for me to be here, and I appreciate everybody that's listening in to the webinar. My voice is starting pretty strong right now, but I will tell you I have a cold, and I feel fine, but I sometimes sound a little croaky. But I hope we'll be able to get through this seminar, through this webinar. As Tim said, this webinar is about what percentage of our equities we want to put into international, and I want to be international stocks. And I want to be clear about the thing that we're talking about. The toughest decision that an investor faces is how much money to put into stocks. In other words, how much overall risk to take. And we spend a lot of time at Biltmore Capital working with a client to make sure that an investor has the right overall risk exposure. So an aggressive investor might want to be, for instance, 80% into stocks and 20% into bonds or safer assets. And a conservative investor, just to pick a ballpark number, might want to only be 20% into stocks and then have maybe 80% of the money in bonds and safe assets like cash. This seminar deals with the second difficult question that investors face, and that is, of that amount of money that they're putting into stocks, whether it's 80% as an aggressive investor or 20% as a conservative investor or somewhere in between, what percentage of that should be put into U.S. stocks and what percentage should be put into the stocks of other markets, China, England, anything other than the United States? And a ballpark answer to that question that I'll throw out there is 75% should maybe be in the U.S. stock market. So when I say that number, I want to be clear what that number means. It means that of the 80% that an aggressive investor has in the stock market, 75% of that 80%, or in other words, 60% of their total assets would be in U.S. stocks and 20% would be in foreign stocks. The conservative investor would have, of their 20% that are in stocks, 15% would be in U.S. stocks and 5% would be in international stocks. So it's interesting that whether you have a lot of stock or a little stock, the ratio of international to U.S. stock is the same for each investor. And that number is a difficult number to come up with. And I'll explain that. And I'll warn you ahead of time that the first 3 or 4 slides that I'm going to cover are a little bit tough and a little bit complicated. If you don't catch every nuance of those first 3 or 4 slides, I wouldn't worry about it. I'm always happy to field questions, not just at the end of this webinar, but at all times for our clients. So after we get through these first 3 or 4 tough slides, the slides will get easier, and hopefully everybody will be able to follow things pretty closely after that. So the most important principle in investing, in my opinion, is to be diversified. High levels of diversification, lower risk without, on average, reducing expected return. But how do we diversify? Well, a lot of people might think that diversifying means that you put a little bit into everything. And that's not what modern portfolio theory says. Modern portfolio theory is the science that's emerged over the last 60 years to use rigorous thinking about how to put together a portfolio. And modern portfolio theory tells us, if you look at the second line of this slide, that every asset should be invested in proportion to its size as a starting point. So if jumping down here in the middle, Apple Computer, the massive Apple Computer Corporation, represents about 3% of the total US stock market. Macy's, which sounds like another big firm, actually only represents about 0.03% of the US stock market. In other words, Apple Computer, the stock, the aggregate amount of stock that is held in Apple Computer is 100 times as big as how much stock Macy's has available. So what modern portfolio theory says is that to be perfectly diversified, to be well diversified or optimally diversified, investors should put 100 times as much money in Apple Computer stock as they put in Macy's. Now that sounds very counterintuitive. It doesn't seem to be diversified between those two firms if you're putting 100 times as much in Apple Computer. It seems like you're in Apple, you're not in Macy's. And I could spend a lot of time talking about this point, but I'm just going to ask you to accept it by faith that modern portfolio theory is correct when they say that even though it sounds counterintuitive, you should invest in every asset according to its size to be perfectly diversified. Now, we don't want to be perfectly diversified for tax reasons and other reasons, and I'll get to that later. But the theoretical starting point is to invest in proportion to market value. That's called, if you look in the upper third of the slide, value weighting. We value each asset according to its size. That's the starting point for diversification. The question becomes then, how do we allocate between international and domestic stocks? And the answer, by the way, is we want to think as a starting point that we would invest in proportion to the size of those stock markets. And we're going to talk a lot about that. But before we even do that, I'd just like to raise the thought-provoking question: why are we even talking about this? Why are we even thinking about how much of our stock money, equity investment, is in U.S. stocks and how much is in international stocks? Because if you think about it, we don't talk about which state the investments are located in. We don't talk with investors and say, well, we've got 13% of your money in Texas and 27% in California and 14% in New York. We don't do that. Or we don't even think about counties. We don't have investors that say, well, I want most of my money in Lake County or something like that. Or cities. We don't think about city borders or county borders or state borders. Why are we so focused on national borders, this U.S. versus international investing? So I've listed 4 reasons here as to why this may be an important issue. political risk, currency risk, which we're going to discuss in the next slide, taxation differences between U.S. and foreign stocks, and other issues such as expense ratios or transactions costs. So there are reasons why we're concerned about international borders, but I thought it was an interesting point that we don't worry about other types of borders. So I think that gets us to focus in on then that this decision should be driven by the types of issues that we see.
Thank you.
So are foreign stocks riskier because of currency risk? So let's take this first example. It's not a stock, but the first example here is, suppose we're going to invest in gold. Well, if we were going to invest in gold, we'd take our money, US dollars, 1,000 US dollars, we would convert it into, if we were going to do it in a Zurich bank, we would convert that $1,000 into Swiss francs, and then we would use those Swiss francs to buy gold in Zurich, Switzerland. And then at some point in the future, we would sell that gold in Swiss francs and convert it back to dollars. And when I explain it that way, it sounds like there's a lot of foreign currency risk. This is a very important point, but as I said, these first few points and the first few slides are going to be tough, but please hang in there with me here, and I think you'll see where I'm going in a minute. So it sounds, when I first said this, that investing in gold in Switzerland involves a lot of foreign currency risk. We convert our dollars to francs, we convert the francs to gold, then when we sell the gold, we convert the gold back to francs, and then we convert the francs back to dollars. But the truth of it is, it absolutely doesn't matter whether you invest in gold through a Zurich bank using Swiss francs or whether you invest in a New York bank using dollars. And the reason is because the price of gold adjusted for currencies is the same all the way around the world. So whether you invest in gold and we call it US dollars, or whether we call it Swiss francs or euros, it doesn't matter. You're going to get if you're a US investor, you will get the dollar-based return that it earned in the US in dollar terms. And the same thing is really true if you stop to think about it. If you were investing in paintings or horse races, if I buy a Monet, a piece of artwork, whether I use US dollars to buy it or whether I convert those dollars to euros to buy it, it isn't changing. The price of a Monet doesn't vary based upon your currency. You're going to pay the same price adjusted for currency, no matter what currency you use. Now, how does that apply to stocks? Well, if we have a high-tech firm whose success or failure is really going to be based upon the international computing sorts of scene, does it really matter whether that firm is located in France or in San Francisco? It isn't clear on a theoretical level, it really doesn't seem like currency risk is driving that. However, if we get down to this third example, does it matter whether I buy a UK bond that's denominated in British pounds or a US government bond denominated in US dollars? That does matter. If I buy a British bond and the British pounds sink in value, then when I get my British pounds back out of that and convert it to US dollars, I will lose money. So what I'm getting at here is, even though the first thought that a lot of people have about investing in international stocks is that they're taking international currency risk, it's not clear whether that there's a lot of currency risk when we really look through those currencies at the underlying assets that we're buying. So I'd like to move to an easier slide now. We've kind of gotten through all the tough stuff. This is kind of a fun slide. It shows the world map, and it shows the different major stock exchanges, and it lists them. The size of the figure is representative of the size of the market, and we can see that the biggest market in the world is the New York Stock Exchange. And probably the second biggest one is the NASDAQ. And the third and fourth and fifth and sixth biggest are located in Asia and in Europe. And we see from this diagram that the US stock market represents almost half of the entire world's capitalization. And there's entire continents such as South America and Africa that represent almost less than 2% of the world's stock markets. So we're coming back to this point now that modern portfolio theory tells us that we should invest in every asset, every market, proportionally to its size. So if we were to follow that prescription for the case of equities, what we would be doing is we would be putting a little less than half of our money in the US, of our equity money. We would be putting a little less than half of our equity money in the US market, stock market, and we would be putting a little more than half of our money in all of the other markets combined. So the next slide here shows over on the right that according to this estimate in this little diagram, that 46% of the world's stock markets are represented by the US. Now that number, if you were to look around the web, you're going to find that number varies tremendously. And you may think, some are as low as 40%, some estimate that number closer to 50%. And you may say, well, that's funny. It really shouldn't be that difficult in this modern age to be able to calculate the percentages of the world's equity markets that are in each location. But it actually gets rather complicated because there's a lot of double and triple counting. We have a lot of exchange traded funds and other products that actually have stocks inside of them. So it becomes a real difficult issue to avoid double and triple counting the assets. And a lot of assets are listed on multiple exchanges too. So it's a more difficult number to estimate than you might think. But we know that the US stock market has risen over the past few years from about 35% to almost 50% of the world stock markets right now. So the question would be, should we put 40 to 50% of our equities into the US and 50 to 60% of our money into international stocks? That's what the previous two slides would indicate, that we should invest theoretically in proportion to size. The US stock market is 40 to 50% of the world. So our equity portfolio should be 40 to 50% US and 50 to 60% international. And think about how much scarier this would be for an investor in, let's say, Portugal. An investor in Portugal, their stock market is less than 1% of the world stock markets. So if you were speaking to a Portuguese investor, you would say to them that modern portfolio theory says that you should invest less than 1% of your money in your own stock market, and you should put 99% of your money in other stock markets. That can be a difficult thing for an investor to think about, that almost every penny of their wealth would be invested in assets that are denominated outside of their home country. So that's not what people do. What most people do is they invest much more in their home country than modern portfolio theory suggests. This is called the home country bias, and that sounds like a bad thing. It's not a bad thing. In fact, I'm giving 4 reasons here as to why, and maybe even a fifth reason, 4 reasons as to why it makes sense to have a home country bias. Home country bias meaning that you invest more in your domestic stock market than its size would indicate that you should, based upon optimal diversification. So why, for instance, do we at Biltmore tend to put 75% of our clients' equities into the US and only 25% into international markets? Because theory is saying that should be closer to maybe 50-50. Well, one reason is political risk. When you invest in an international market, uh, you become, so to speak, a second-class citizen with regard to political risk. If you invested, for instance, in assets in Venezuela and the government nationalizes the industry, the foreign investors are going to be tremendously disadvantaged in those sorts of disputes. So we worry about political risk. Nationalization is an extreme example of political risk, but there are other risks of heavy taxation of foreign investors, for instance. A second one is currency risk. I talked about that earlier, and I said that it's not clear really how much currency risk is involved in equity investing. It's not as bad as most people think it is, but I think it is in effect. A third one is the psychological effect of looking at a portfolio. And you might look at a portfolio and you see Walmart, and I think everybody listening to me knows what Walmart is, and they literally see signs of Walmart every day when they go out shopping. And then there's this other firm, I don't even know how to say it, Cinepec. And you'd say, well, should I invest in Cinepec? Well, Cinepec is the biggest corporation in the world by some measures. So it's actually a Chinese firm. So it's a big difference, though, to us to understand as Americans the distinction between the risk that we're taking when we invest in Walmart and the risk that we're taking we invest in a huge firm that we've never heard of. So there's comfort with the familiarity, and there's nothing wrong with that. I think it's good to be able to look at your portfolio and to understand the sorts of assets that you're investing in. A fourth one, and this is an important one, but we're all human beings, and we tend to have our emotional biases. There's really good evidence that indicates that our happiness is not so much related to how rich we are, but it's really related to our expectations. How much wealth we had a year ago, how much wealth our neighbors have. So happiness is a relative is based partly on wealth, but it's more a relative wealth level. So there's a lot of comfort by investing in stocks the same way that your colleagues and friends and relatives are investing in stocks. I think these are actually valid reasons for people to choose to invest more in the stock market of their own nation rather than to invest strictly according to the size of each stock market. I'd like to talk about this last point, this fifth one, and that is, what about the belief that the US market will or will not outperform other markets? I mean, why aren't I talking here about why we make this decision on the basis of whether we think the US stock market's going to go up or down, or whether the international stock market's going to go up or down? And the answer is that wealth management, long-term investing, needs to emphasize principles such as diversification, proper risk levels, appropriate tax strategies, low transactions costs. These are the ways that wealth is accumulated and managed properly through time. And we want to tone down the amount of risk that we take in trying to pick the asset classes that might go up or might go down. So I'm listing that as a perhaps. I'm not saying that we completely ignore this issue, but to me, the focus it needs to be on issues such as diversification, proper risk levels, taxes, transactions costs. And I speak to that here, that in judging the future equity market performance of the US domestic market versus the equities of other countries, it shouldn't be based on hunches or trendy thinking. And I put an asterisk there, and I located at the bottom, and this is a joke. I like the joke. And it is that when we think about hunches and trendy thinking, it's going to be twice as effective as basing investment decisions on astrology. And the joke there is that astrology is no way to predict the stock market, but I also don't think that hunches or trendy thinking are. And you hear a lot of that when I tune into CNBC. I just listen to a lot of blather, I would call it, trendy thinking and hunches. The U.S. market's hot, or the China market is where the future is. And we really want to be very clinical and logical about this. So if you look at the middle of this slide, it talks about basing our decisions on sound economic reasoning and rigorous analysis of historical data. Now, I'm not going to present either of those today in terms of sound economic reasoning or rigorous analysis of historical data, because we don't have time to do it. But that is the process that we're going through at Biltmore when we make this decision of how much money to invest in international rather than domestic stocks. So let's take a little look at the sort of things. We look at this regularly. In fact, every quarter at every investment committee meeting, we look at a chart like this. And what this is doing is summarizing. If you look in the second and third columns here, we have domestic equity markets represented by the S&P 500 and international markets represented by the MSCI EAFE. And these ratios are common metrics that people use to look at whether a market is highly valued or appears to be cheap. And if you look at this, you see that the domestic market right now is selling at a PE ratio of 21. Actually, this number is back in September. It's selling at a PE of 21. That's pretty high. The international market's only at 14. If you go to the last row, the dividend yield on the S&P 500 was 1.8%. It was 3.2% of the international market. These are metrics that say that the U.S. market is rather richly priced right now relative to the international market, even more so than the emerging market. So I happen to be very enthusiastic about the institutions that this country has with regard to property rights and justice and a spirit of entrepreneurialism. I'm very bullish on the U.S. stock market. However, when I see valuations like this, I begin to think that however bullish I might be about the U.S. stock market, it's already rather richly priced relative to international stock markets. So we want to take a look at that when we're making that decision. This is a chart of the U.S. stock market versus the rest of the world, and the thick lighter blue line that starts on the bottom at the left and then goes up to the right is the U.S. stock market, and the narrower, darker blue line that is on the top, on the left side of it, and is trailing off on the bottom on the right is the foreign market. And what this is showing is that in the first decade of the millennium, the new millennium, the international stock market was substantially outperforming the U.S. stock market adjusted for currency. But what's happened in the past 5 years is that the U.S. market has very substantially outperformed the foreign market. Now, a lot of people tend to jump on trends. They say that the trend is your friend. I believe just the opposite, that once a trend has been well established for something like 4 or 5 years, it tends to reverse. That's what we saw 2005 to 2008. The international market was doing so well, then it didn't do so well. In the last 5 years, the U.S. market's been doing very well relative to the international market. That certainly is a time to give us to pause to think that maybe it's time for it to come back in line. I talked about how currency rates may or may not matter as much as we think they do, but this is a very good diagram from the Federal Reserve Bank in St. Louis, and it talks about it shows the relative value of the US dollar relative to all the other currencies. And 100 has been kind of the long-term average here. And you see that from the mid-1990s, until 2003, the U.S. dollar was very, very strong. And then during that first millennium, first decade of the millennium, the U.S. dollar came way back down near its lower range, and it soared once again. So my concern would be that the U.S. dollar has been very strong. It's made the U.S. stock market perform very, very well relative to foreign markets. But when we look at a diagram like this, I worry that if we look too much at recent history, we get all excited about the U.S. stock market. We get all excited about the U.S. dollar. But just about the time that we've had 3 or 4 good years or 5 years of performance in an asset or an asset group, it's often that market reverts. So we don't want to jump on whatever asset group has performed well in the past 3 to 5 years. That's a bad investment strategy. And that's what a lot of people do. We also don't want to overreact to something that happens. We went through a lot of volatility obviously in November and October, and we don't want to overreact to those painful short-term experiences. We want to stick with the long-term decision-making that got us to where we are. And the last slide that I want to show is a fascinating slide to me, and that is it shows what pension fund assets have been doing for the past 20 years. And it shows it by countries. The top purple line is the US. And it's saying that pension funds used to have a little over 80% of its equity in domestic, and that number's been drifting down to maybe 60%. And that's a tremendous home country bias to put so much money in the US stock market rather than diversifying fully across the world. But look at some of these other nations. The orange line is Australia. Australians used to put 70 to 80% of their money in the Australian stock market, which is a tiny stock market consisting mostly of natural resources. It's still over 50%. And Canada used to put 60% of its money into its domestic stocks, which are not very well diversified. And luckily, if you look towards the far right side, that number's come down tremendously. The overall trend that this diagram is showing is that the home country bias is being reduced by pension funds. And I think that we need to take a sober view of that. Now, pension funds have an ability that they're investing for a variety of participants, and they can diversify across risks a lot better. But it's a point well taken that the home country bias, this idea of putting so much money into the U.S. stock market relative to international markets, is something that modern investing is pulling us away from. As I said, Biltmore Capital tends to put 70 to 75% of its equities into U.S. markets on behalf of its clients. That's done very well relative to these global allocations over the past 5 years. But maybe now that the U.S. stock market has performed so well on a currency-adjusted basis for the past 4 or 5 years, maybe it's time to pull back that home country bias and invest closer to 60 to 65% of our money in the U.S. stock market. Major takeaways: it's a domestic versus internationals is a difficult decision. It should be based upon sound economic reasoning and sound empirical analysis. Domestic equities performed very well in the past 2 to 5 years. Maybe it's time to be concerned about having too much of a home country bias. But at this point, Biltmore is staying the course. We continue to tilt towards domestics relative to a market weight allocation. And I think, Tim, it's time for questions.
Yeah, that's great. Thank you, Don. That was excellent. You brought up a lot of great topics. One of the major ones that I enjoyed was really how these endowments and pension funds have been focused. They typically, a pension and endowment, right, is meant to pay out a long cash flow stream, be well diversified, and kind of an all-weather type of portfolio. We've seen a lot of great studies show that Harvard, Yale, CalSTRS, a number of different domestic pension funds have been really heavily allocated into that international space. So it's, I think a lot of what we tend to focus on in our investment committee is not really how the herd is going, but also how we try to view the world and our home country bias as well. Some of the questions, Don, that came across, while you were talking, we do have an international client actually viewing today, and just kind of coming from them, would your advice differ for an American choosing to live abroad in terms of investing internationally?
Yeah, that's a great question. We tend to think, I talked about the home country bias as partly because of the people around you and the assets that you're familiar with, Walmart versus an international. But if you're living in Europe or Asia, then you're probably much more familiar with these other corporations, and you're competing to buy real estate property with, or to your friends are invested in international markets. They're not going to be invested so much in U.S. markets. So I think that it's fine. If I were deciding to retire in Europe, I would probably consider Europe to be my home country bias, to be perfectly honest, unless I was going to be passing that wealth on to my heirs who were living in the United States. You would see through that for heirs. But yes, I think that this would change with wherever your home is, even if you originated in the United States.
So when we look at our portfolio and specifically talking about that international segment, how do we decide between developed markets and the emerging world?
Well, I think that good question. That can be answered the same way we answer everything else, which is market weights. In other words, we have a home country bias for U.S. versus non-U.S., but within those categories, whether it's in the U.S. between small stocks and large stocks, or whether it's internationally between small countries and large countries, I think we want to use value weighting. We want to weight it on the basis of the size of those markets. So even though, for instance, in the U.S., there's thousands of small firms and only hundreds of mega firms, we put much more of our money in those mega firms. And the same thing with the countries. Even though there's lots of tiny countries out there, we want to have a relatively minor allocation to emerging markets and a relatively larger allocation to developed markets because of the size of those markets. It goes back to that initial point that I talked about, which is that our starting point should be to invest proportional to size. And that's what we should do in emerging versus developed markets.
I've heard a lot of investment philosophies out there, one of them being that a lot of the companies that are actually domiciled here in the United States are multinational companies like ExxonMobil, United Parcel Service. They do business around the world. Why should we go internationally? Why can't we just get access to the international world through our companies?
Well, that's a good question, and we do that. In other words, when we're thinking about the biggest firms in the U.S. stock market, Amazon and Apple, the tremendous business that they're doing abroad, McDonald's and Walmart, I mean, they're all doing tremendous amounts of business abroad, our pharmaceuticals. So when we invest in the U.S. stock market, we're investing internationally. And I think that, on the other hand, when we invest in international stocks, whether it's car companies or banks or anything else, they're doing business in the U.S. as well. So it's all very interconnected, and I think that so I think what I've been saying adjusts for that fact. So I don't think it's enough to simply buy U.S. stocks and say we have some exposure through U.S. stocks to those foreign markets. I think we actually have to reach over and grab foreign stocks as well.
Got it. On the international, a lot of ways that we dive into those international funds when we look at an index or a manager. every now and again we come across these selections of currency hedged or dollar hedged funds. What are the pros and cons there? Just maybe a couple. I know there are a bunch of them.
Well, in the case of I'll answer an easy part of that question first. In the case of bond markets, I think it's a very straightforward question to say, do you want to be currency hedged or not currency hedged? Currency hedged means that the mutual fund has gone out and is engaged in derivative contracts so as to eliminate the effect of currency changes on the dollar-based return. So if we invest in a U.S. Currency hedged fund that's investing in international bonds, if it's currency hedged, you're protected from currency fluctuations. If it's not currency hedged and you invest in the foreign bond market, you are very exposed to currency risk, just like I talked about with that one slide, investing in a UK bond. But it's even then, it's a question of, well, is it good to be 100% of your wealth tied to the US dollars? Sometimes I think it's good to actually not be currency hedged, because putting all of your eggs in the US dollar basket might not make a lot of sense. But we do tend to think of our wealth in terms of US dollars. So I can understand that some people would want to be currency hedged when it comes to bond investing. But when it comes to equity investing, I'm not sure that equity currency hedging is necessary. And that goes back to that slide where I talked about investing in paintings or horses, racehorses, or gold. What you're really investing in is real assets and earnings power, and the currency that floats through to get to the U.S. dollar dividends that you receive, I don't think are as important as the value as to what's going on with those assets. So currency hedging, quite likely, if you're talking about bonds, I don't think is important if you're talking about stocks.
Well, great. I always get confused with that. It's a very tough making some of those selections when you're presented with them. One of the last questions here we'll ask is a little more politically driven, I guess. How would we look at international allocations, given that there are some tariff disputes and with China and therefore pretty much the rest of the world going on right now?
Good question. I think this China trade dispute is huge. I think that on the positive side, it could result in a correction of some real fundamental inequalities that exist in our trade relationships, and this has been the most important one. On the other side, it could be a very painful experience to get those fixed, and they might not get fixed. So there's a tremendous amount of uncertainty. I think it's been driving the markets. And I have no expertise in knowing which way this is going to go. And I think that's an important point to say that we track it. I think about it obsessively an awful lot, but I don't want to bet client money on my theory as to whether it's going to resolve well or not well, because we don't have, in my judgment, informed opinions. So what we do want to do is we want to try to manage our clients' portfolios so that we're taking the appropriate risk level with respect to these types of risks. So I wished I could give a more definitive answer, but I guess I got to know when to hold them and when to fold them. We just don't know how this is going to turn out. We should feel well positioned in terms of taking the right level of risk and just be patient, and whatever happens is what happens.
I think that's a reasonable answer. Well, thanks, Don. We appreciate your time, as always. It's a great pleasure learning from you. And, ladies and gentlemen, thank you for your time. This is a really important time in markets and in the world. And we thank you again for taking a moment. We will be sending out a replay of this if you did miss some of the beginning. Also, we do post a lot of this content to our website. Visit it at www.biltmorecap.com. Follow us also on Facebook. I think that's another great place. We're always driving a lot of content. As always, if you need anything, please don't hesitate to reach out to your advisor or just give us a call, 888-391-4563. Thank you, guys. Enjoy the rest of the week, and good luck out there.